This one's a heavy one today. So get your helmet on, Mr. Batista.
I'm ready. Let's do it.
Get a mitt, get a ball, get a pen. What else do you need? Mitt, ball, pen, bat.
I don't know what you can do with a pen, but go ahead.
Well, you're keeping score.
Yes, okay. Gotcha.
Some people play, some people keep score. You're a scorekeeper.
There you go. I knew it. Something heavy.
Hold on, go back, Beth, for one slide. This is the fourth one in the series of Thursday zero DTE discussions, and this one we're calling Theta Decay of Zero DTE Options. This is a study I've never seen anybody do anything like this before, so I think this is going to carry. It's going to get a lot of feedback, industry feedback. Let's take a little look. So zero DTE options have significantly more premium per day than any other expirations. Usually the implied volatility of the zero DTEs can be roughly 25 to 100% greater than that of the later weekly options. And what we did on the right-hand side of the page here was we highlighted, I don't know how easy that is to see, but on the Tasty platform, we show the zero DTEs, and you can see it here. It has a 22 implied volatility. I think we just took this from yesterday. But then as you start to go down to the rest of the week, you can see how it drops off significantly into the mid-teens and things like that.
It's almost cut in half.
Yeah, it's almost cut in half. Just like they said, 25 to 50%. Let's go to the next slide, please. So we decided that we would split the trading day into 3 equal parts to do this study. And again, like I said, this is just
2 hours and 10 minutes each.
Yeah, well, that's your 6.5 hours.
Yes, I got it.
So we split the trading day into 3 equal parts of 2 hours and 10 minutes. That was arbitrary.
It's very cool.
And we looked at the actual theta decay of the at-the-money straddle and the 20 delta puts and calls. Okay? So what is the difference between days with high versus low zero DTE implied volatility? This is the little $1 million question here, Mr. Batista. Do you want to do this? I mean,
low implied volatility, high implied volatility. Do you get paid more for having the high implied volatility? Are you more at risk with the low volatility, or is it better?
What we're checking here is when volatility is high, are you better off putting a position on or taking a position off in the first part of the day, in the middle of the day, or late in the day? And does that change depending on if volatility is high or low? Okay.
Then, I don't know the answer, but go ahead.
Of course you don't know the answer because we haven't done the study yet. SPX, we studied the at-the-money straddle and the 20 delta puts and calls. We recorded the actual daily option decay as a percent of the opening price throughout the day. So the times here, remember, 2 hours and 10 minutes, 8:30 to 10:40, 10:40 to 12:50, and then 12:50 to 3 p.m. All right? We use the above study on the following options: zero DTE with an expected move of $25 or less, zero DTE with a expected move of $50 or more, and zero DTE options on the first day with an average market implied volatility. Okay, next slide. All right, got your helmet on? Here we get into the meat. Zero DTE straddles lost half their value in the last third of the day. For days with a larger expected move, the decay was evenly distributed for the first 2/3 of the day. So the first thing we're going to look at here in this SPX study of the theta decay of zero DTE options is we broke it down into 3 separate time frames. And as you can see here, in zero DTE options, when you have a small expected move, they lost 30% in the first, let's call them tranches, I guess. In the first
tranche from 8:30 to 10:40. The first
they lost 30%. They lost 20%, so a little quieter midday, and they lost 50% in the end of the day. So if you're wondering when is your premium going to come in, that's what you're looking for.
Now it's going to be 50% of a smaller number, probably, right? Because it's a larger number in the beginning of the day. So straddle, all things being equal, straddle's going to have a higher price in the beginning of the day.
Yeah.
And as time goes by, it's going to decay, right?
And then with a large expected move, the numbers were kind of were similar, but you made less in the first hour, or the options lost less in the first hour, and they lost a smaller amount in the second hour, and then they got killed in the end of the day when it finally came in. What's interesting here, this is just at the money straddle decay. Okay.
Right.
We don't really sell at the money straddles.
No, but it's an interesting thing to look at, especially in 0-day options. I mean,
well, now
it's
when
gonna
somebody
use a lot of buying power also. I mean, you're looking at
Yeah.
what, 60,000 for one contract? 80,000. Okay.
SPX about 80,000 one
cool.
contract. But what you're looking at here is when somebody asks you, what are you looking for? Well, now you know the answer. In the first third of the day, between 20 and 30%. In the second third of the day, between 20 and 25%. At the end of the day, about 50%. If you're doing the straddle. Let's go to the next slide.
You're right, 82,000.
Okay, so for 0 DTE strangles, small expected moves meant the out-of-the-money options lost half their value in the last third of the day. This is very similar to the straddles. When the expected move is large, the strangles actually lost half their value in the first third of the day. This is the only thing that seemed that was really interesting to me, was that when you have a large expected move and you're on 0 DT, they on a strangle, they got killed in the first tranche.
It's so beautiful the way out of the money options and high implied volatility, large expected move really can collapse.
Yep.
Wow.
In the 20 delta strangle. I mean, obviously the last tranche of the day is the big payout, but that's the one we're usually not holding till.
Right.
Because that's when the moves have set. That's when you get yourself into the most trouble too. I like that first tranche of the day, that 8:30 to 10:40, which is in that range of 25 to 30% and 45% on a large expected move. I kind of like that.
Yep.
Let's go to the next slide, Beth. So here's something really interesting. For each dollar of premium on at-the-money straddles compared to our normal 45-day time frame, the decay for 0 DTE options is roughly 100 times faster than our typical 45-day trade, regardless of the strategy that you implement. So what we found here was that basically when you have a trade that's essentially your when you compare your first day in the trade, 45 days 20 delta short strangle or 45 days short straddle, you're talking about a fraction of 1%. And when you multiply that number by 100, you get to what actually happens in the first hour of your 0 DTE. So it's 100 times faster. Does that mean you have 100 times more risk? Well, yeah, in this example.
Yeah, theoretically, yeah, sure. Yeah.
So when you see somebody they're doing 10 lots, let's just say, of 45-day strangles, you probably don't want to do much more than a 1 lot of your 0 DTEs. You're not doing 10 and 10. And don't forget, the SPX is 10 times larger in size anyway. But that's pretty cool, isn't it?
Very.
That it's basically works down to just pretty much exactly 100 times.
Very, very.
Let's go to the takeaways. So, days that have a larger expected move will cause a slightly different decay curve for 0 DTs than days with a smaller expected move. Usually the last third of the day resulted in 50% or more of the total decay. So when anybody asks you about 0 DT options, that's the single most important takeaway here, is that the last half of the day is about 50%. I'm sorry, the last third of the day is about 50% of their total decay. The other ones are divided between the first and second hour. And then compared to a typical 45 days to expiration trade, the actual decay for 0 DT options is roughly 100 times greater as a percentage of the total premium, meaning risk definition is much more necessary. What that means is that if you did a 45-day to expiration trade and you sold it, you can make about 0.3% in 1 day, and you can make a lot more, or maybe whatever it is. But you can make 100 times more in the 0 DT, but you take 100 times more risk.
Very good. Good job. Good job out of team. Nice little study there. Really liked the way they broke it down. We're going to take a quick 90-second break and come back. We got more Tasty Live coming up next with, oh joy, Mr. Scott Sheridan next, Tasty Trade World Headquarters.